Hey everyone, welcome back to Corporate Decoded, the place where we break down the financial statements of big companies. And today we have WideOpenWest, or WOW as they're known to most people, and their latest quarterly report. You know, these reports usually have a lot of numbers, but sometimes a few very interesting details hide in plain sight. In fact, some of the stuff we found in here could really change how you see this company. So this is WideOpenWest's report for the period ending June 30, 2025. It's like a quick checkup on how the company is doing financially over the last 3 months and also the first 6 months of the year. Think of it as a progress report, and we're going to decode it for you. Before we dive in, if you like getting clear and simple explanations of these complex company reports, make sure you hit subscribe. Also, we have a fantastic community over on our Discord server, linked down below, where we discuss these filings and much more, so come join us. Alright, first up, let's peek at the company's financial snapshot, the balance sheet as of June 30, 2025. Now remember, these numbers are in millions of dollars. They had current assets, which are things they can quickly turn into cash, like cash itself, accounts receivable, and other assets totaling 10 for 310. Into Toshin 2022 and its flip year wheel yo, and a flip side, their total liabilities were a hefty 1,320.6 million. That means they owe quite a bit more than they have readily available. Looking a bit closer at their assets, their accounts receivable, specifically the trade ones net of money they don't expect to collect, were 34.3 million. This is essentially the money customers owe them for services already provided. Now, for the part that shows how much the owners actually own after everything else is paid, the total stockholders' equity was 189 million. This is a pretty significant drop from 288 million at the previous year, which is definitely something to keep an eye on. Moving on to how the company performed in terms of making money, the statement of operations shows us their revenue and expenses. For the 3 months ending June 30, 2025, they brought in 144.22 million in revenue. That's down from 158.8 million in the same period last year. This revenue drop means they're making less money overall. For the first half of the year, the revenue also went down from 320.3 million in 2024 to 294.2 million in 2025. That's an 8% decrease, and that's a substantial chunk of change. Let's break this down a bit more. Their subscription services revenue, which is usually the bread and butter of these companies, dropped by 9% for the quarter and 8% for the first 6 months. They attribute this to customers shifting away from their services and a decrease in the number of people subscribing to their high-speed data, video, and phone services. However, their other business services revenue held relatively steady, mostly staying flat quarter over quarter. This category includes things like data center services, so it's good they're not losing ground there. On the expense side, their operating costs, excluding depreciation and amortization, went down by about 15% for the quarter and 14% for the first 6 months. This is a positive sign that they're managing those direct costs better. Their selling, general, and administrative expenses also saw a dip. They were down 5% for the quarter and 9% for the first 6 months. The report mentions this is partly due to insurance money they received, which offset their expenses. So while they're cutting costs in some areas, the insurance money is a bit of a special item. Depreciation and amortization expenses were also a bit lower. This is generally good because it means less of their assets are losing value on paper. Now here's where things get interesting. Their interest expense jumped up by a massive 44% for the quarter and 37% for the first 6 months. This is a big deal, and it's mainly because they're borrowing more money, and they also entered into some financial contracts called interest rate swaps. Let's see how all this affects their cash. For the first 6 months of 2025, their net cash provided by operating activities was 52.8 million. This is down from 86.6 million in the same period in 2024. That means they generated less cash from their day-to-day business operations. In terms of investing in the company's future, their capital expenditures were 86.8 million for the first half of 2025. This is lower than 123.5 million they spent in the same period in 2024. They say this decrease is mainly due to the timing of building out their network in new areas. Financing activities, a bit of a mixed bag. Net cash provided by financing was 25.7 million for the first 6 months of 2025, down from 34.2 million in 2024. This change is mostly because they borrowed less on their credit lines and paid back more on their loans. Now let's talk about their debt. As of June 30, 2025, their total long-term debt and finance lease obligations were over $1 billion. The super priority loans alone were $907.2 million from their first out term loan. They have a lot of debt. According to the report, their effective interest rate on this first out term loan is around 8.92%, which is quite high. They also have a revolving credit facility. As of June 30, 2025, they had about $135 million drawn from this facility, which has a total borrowing capacity of over $250 million. Here's a really important piece of information. In August 2025, they announced a major deal. They're being bought by Bandit Parent LP, which is backed by Digital Bridge and Crestview Partners. This is huge. It means WideOpenWest will no longer be a publicly traded company and its stock will be delisted from the New York Stock Exchange. The deal is expected to close by the end of the year or early 2026. Interestingly, a big shareholder affiliated with Crestview, who owns about 37% of the company's stock, has agreed to a special rollover deal. This means they are basically rolling their investment into the new parent company and supporting the deal. Now for a bit of a red flag here. Management admitted that their internal controls over financial reporting were not effective as of June 30, 2025. They specifically mentioned that they didn't have enough documented evidence and review for certain numbers used in their annual tests to see if their assets lost value. This was a problem last year too, and it's still a problem. This could mean potential risk in how accurately their financial numbers are presented. Although they do say no material misstatements were found, they have a plan to fix this, but it's going to take time. And about that buyout deal, remember that even though it's announced, there's no guarantee it will actually go through because it needs approval from regulators and shareholders. If it doesn't happen, the company could face some serious challenges as outlined in their risk factors. A small but interesting detail in the report is about how many shares they bought back. For the period ending June 30, 2025, they repurchased a total of 11,672 shares. These shares were actually taken back from employees to cover taxes when their stock awards vested. It's not a big buyback program, but it's a way they handle their stock compensation. Looking at the table here, you can see they bought back shares each month in the second quarter of 2025. It's a small number of shares, but it's worth noting they are managing their own stock. So what's my take on all this? WideOpenWest is facing some headwinds with declining revenue and increasing interest expenses. Their substantial debt load is also a major concern. The pending buyout offers an exit strategy for shareholders, potentially at a decent price of 5.20 per share. However, the fact that their internal controls are still not effective raises questions about the reliability of their financial reporting, which is a fundamental aspect of any company's operations. The company is a bit of a mixed bag right now. They're trying to grow through new market expansions, but they're also heavily leveraged and facing competitive pressures. The big question is whether this buyout will go through and what that means for the company's future. If the deal falls apart, they'll likely face significant challenges in managing their debt and improving their financial performance in the public market. Alright, that's our breakdown of WideOpenWest's latest filing. What's your take on these numbers and what they signal for the company's future, especially with that buyout happening? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and of course subscribe for more deep dives into corporate finance. Don't forget to check out the Discord link in the description to join the conversation. Thanks for watching. See you next time.